Let's turn now to our roundtable with Fed watchers to really talk us through that Fed decision, get their thoughts. Al Broaddus is the former president of the Richmond Fed Bank, and like all Fed Bank presidents, he's been a member of the Fed's policymaking meeting at times. Also with us, Dean Maki is a former Fed economist, now the chief U.S. economist at Barclays Capital. Bloomberg ranks him among the best economic forecasters for the broad economy. So two perfect people to talk about what the Fed had to do. Al, I want to kick it off with you. Is this what you expected from the Fed, and what does what we got from the Fed tell you about the outlook going forward here?
Well, Carol, I think it was a close call for the committee. I expect there were people on both sides of the issue. I actually guessed right for once in my life on this particular decision. I think, you know, if you look at the overall statement that they've released about an hour or so ago, it shows that, like everyone else, the Fed sees this recovery moderating. It sees it hitting a bump in the road. Some of the momentum appears now to have been lost. And so what it was trying to do with this action, I think, is send a signal that it is aware of this and prepared to act strongly if it needs to. Keep in mind that what it's doing with this reinvestment of payments and so forth is quantitatively not a huge move in terms of the dollars involved. What it's doing is preventing a gradual, slow decline in the Fed's balance sheet and essentially reinvesting those proceeds. It's way short of any really big quantitative easing, but it's an important signal because it tells the financial markets and it tells the public that the Fed is watching the situation carefully and ready to take stronger action if it needs to.
Is it setting us up, Dean, for another move by the Fed? I mean, everyone knows Ben Bernanke likes to wait and see. He's not going to jump, but he also doesn't want to, he's made clear himself, doesn't want to wait too long and repeat the mistakes made during the Great Depression.
Well, I think it will lead markets to expect large-scale asset purchases if the data remain on the soft side. I think the danger with this kind of a move today is it really does send a signal that the Fed is getting worried about things, but with such a small response, it's similar to announcing that we're going to cut the funds rate by a couple basis points. You know, it really doesn't address the fundamental situation if the Fed really is losing confidence in the recovery. So I think that's the danger in it, is it may just give the negative signal without much reassurance.
Well, that's a good point. I mean, Al, when you look at the batch of data, we got a bunch certainly today. We'll talk about that in just a moment. But I mean, when you look at the economic data, does it say to you that things are improving even ever so slightly, or no, that there could be trouble ahead, significant trouble for the economy in the next 6 to 12 months?
Well, Carol, I mean, I think the most recent numbers, particularly the job market report on Friday for July and the second quarter GDP report, were all weaker than expected. It suggests that, at least for the moment, the recovery is slowing down. Let's pick a couple of points here. One is that, you know, recoveries are almost never totally smooth. These kinds of pauses, or whatever the right word is, have occurred in other recoveries at about this stage, after you get the first impulse from inventory rebuilding and so forth. So it's not a huge surprise. I'd also make the point, I don't want to make this too strongly, but there's some good numbers out there. If you drill down into that second quarter GDP report, into some of the components, you see, for example, that business spending on equipment and software grew at a quite rapid pace in the second quarter. Not surprising, given that many business firms have cut costs aggressively, their balance sheets are strong, they're ready to spend for new equipment that they may need. So it's, you know, it's still a mixed picture.
Dean, does it make sense for the Fed to do this, or have we gotten to a point where they really can't produce any incredible results no matter how much money they print here?
I don't think interest rates are really the issue of why economic growth right now is a little bit sluggish. I think that in a sense, it just will take the recovery some time, and I'm not sure that pushing the 10-year Treasury up or down a few basis points is really going to make much difference on that front. I think if the Fed really wanted to make a bold statement, then they really should do major asset purchases. We don't think that's needed at this time, but today's statement is just somewhere in between. Something that doesn't do a lot for the economy.